Hi, this is Baird with Simple Wealth, and today I wanted to talk about the value of time with all of your investments. The younger you are, the more important it is to get started early with every single investment you're making. That could be the investment in your company's 401k that's giving you free money. And that could also be investments that you're making on the side into your own brokerage account like Robinhood, Ameritrade, Schwab, Webull, all of those things. Please remember to subscribe to our channel as you see new videos come out. So with the value of time, we need to think about how investments grow over time and how powerful time is in every single investment strategy. And I want to share with you a couple of examples that I recently figured out from my early life when I wasn't investing at all, and some of the biggest mistakes that I made in investing. All right, so when I was growing up, our parents taught us nothing about investing. They taught us how to save money, and they taught us that it's important to work a job where you're earning enough money to support yourself, and it's important to not go into credit card debt. But outside of those things, they really didn't teach us some of the foundational things about money, including investing from as young of an age as possible. And when I went back, I thought about when I was trying to buy my first house in 2021, and that I barely had enough money to get that down payment going, even though I had a good paying job for about a year beforehand. And I looked at if I had invested just $100 a month from age 18 when I graduated high school until I was 33 and buying my first home, how much money I would have, how much that seed money would have made in the long run. So I want to show you this investment calculator on nerdwallet.com. We're going to say that I invested $100 a month, age 18 to 33 is 15 years. And we're going to use a conservative estimate of a rate of return of 8% per year, saying that the investment is going to grow 8% every year. Now, it's probably going to be higher than that, especially if I had done like the S&P 500, and assuming this is a major index fund, like a market fund, it would have grown more than 8% between 2005 and 2020. So let's take a look at this. $100 a month invested from age 18 to age 33. $34,800. How much money would that have been if I had just thrown $100 a month for 12 months for 15 years into a savings account? That would have only been $18,000. In that period of time, just at an 8% rate of return, which is a little conservative for the market, that money is almost doubled. If we take that up to a 9% rate of return and calculate that, it jumps up to $38,100. That's a little more than doubling your money in that period of time. So the younger you are, it's really important to start investing that money early in mutual funds, index fund ETFs, things like VTI, VOO, the S&P 500. When you put your money into those things and allow time to be your ally, time actually becomes your greatest weapon in investing. Sometimes it's more important than how much money you're putting in. If a 40 or 50-year-old starts investing their money, they're going to need way, way more money to catch up in that period of time. This amount of money, even looking at the 8% rate of return, that's about $20,000 more than a down payment I had for the condo that I bought. It would have enabled a lot more things. I probably would have bid on different properties if I had had a $34,000 down payment rather than a $15,000 down payment. It was a pretty meager down payment. I mean, a lot of times it's recommended that you have a 5% or 10% down payment. Most young people can't afford a 20% down payment on a house unless it's a shack because it's just too expensive. So getting your money into the market sooner to work for you is really, really important. Some of the mistakes that I made when I first started investing in 2015 was investing in things that were not real companies. And one of those I'm going to show to you. In 2015, when I first started investing, I was just throwing darts at a wall. I really didn't know what I was doing. I did not take professional investing advice. I was looking at stock twits and reading Twitter feeds and doing all these things that really don't help someone when they're first getting started in investing. I didn't know what the heck I was doing. What ended up happening was I had a few $1,000 And I was, just kind of picking random things here and there, and also using an investing platform that was charging me $10 for every single trade. So I couldn't really make smart decisions about what I was doing. And I think Robinhood did exist at that point, but it wasn't very popular in 2015 yet. So one of the stocks that I ended up buying is not even a real stock. It was a derivative. It is a derivative. And for a while, let's look at the 5-year here. For a while, when I was investing in this in 2017, I believe 2016 and 2017, this derivative that tracks volatility in the market was making me a lot of money. I more than doubled my money in a year period of time. But the problem with that was that I was just guessing. I was reading things that people on the internet were saying, random Joes, and I didn't know why I was making money. And I didn't really even understand the danger of investing pretty much all of my money in a derivative. A derivative is not a real company. A derivative represents something derived from something else. So in this case, I didn't own a stock. I just owned shares of a derivative. I didn't own Apple. I didn't own Microsoft. If I had bought any of those things, I wouldn't have lost almost all the money I had gained in a year. Almost all of it evaporated in about a 2-week period that you can see right here. This derivative went from, about 540, 550 in value, poof, to a couple of weeks later, and it was worth 1/10 of what it had been worth in that period of time. And I didn't understand really why this happened. I had to dig into it more. But after that point, I stopped investing in derivatives. And I pretty much focused on major companies. And then I focused on index funds. And since that time, I've seen my money grow a heck of a lot more. You really can't go wrong with index funds as long as you're doing things like the S&P 500 and you're doing things like a broad market ETF like VTI. But when you don't know what you're doing, it's really important to educate yourself, because you're going to make mistakes if you don't know what you're doing. And so what I always tell people is, especially people younger than me who haven't started investing yet, is just buy a broad market index ETF or buy the S&P 500 or buy a growth fund. Because if you do that, you could put in $100 a month and sometimes even see a greater rate of return than 8%. I was actually just talking to one of my siblings about this earlier and saying, if you could put in 100 a month, and let's say that rate of return went a little bit higher because we're going to assume a little more growth. And that, she may have a little less time. She might only have, let's say 10 years, she's 20. So 10 years before you want to buy a house, that still could be a down payment for a house, but that's outside of money that you're saving. This is only $100 a month that you're investing. So you do want to have some money in a savings account, maybe somewhere between 3 to 6 months of expenses and savings. But once you go beyond that point, it's really important to start investing your money so the money sitting in a savings account doesn't lose money to inflation. Even if you take in a low inflation percentage every year, 2 or 3%, the money in your savings account is actually losing value because it's not growing for you over time. It's just sitting there earning a fraction of a percent of interest. As of this video, December 2021, most high yield savings accounts are paying about 1/3% or 2/5 of 1% as a rate of return on your money, which means that you're actually losing a lot of money. The bottom line is you want to start investing as young as you possibly can. And no matter what you can afford, it's important to just get started. Let's say you're 18 and you could only afford to do $15 a month until you were 30. We'll go with that conservative 8% again. You're going to have $12,000 by the time you're age 30 if you can put just $50 a month into a major index fund in the market. So getting started young, diving in, not getting distracted by the hype and the meme stocks and the hodls and all this nonsense. I can tell you, being somebody that's lived through that it's not worth it. It's much better to be disciplined about what you're doing and to also make those investments automatically. There's a couple of platforms, including RobinHood, which I've got a link in the description below. If you sign up, you'll get one free stock. Same thing with Webull. Several of these platforms allow you to automatically invest money every month to help with your future. So I hope that was helpful. If you like this video, please subscribe to Simple Wealth, subscribe to our channel, and smash that like button. We really appreciate it. Thanks for watching.